Julian, I'll start off with you. 3,000 is your call for the S&P 500 and 2 rate cuts. So what are you looking for out of Jay Powell's testimony?
Well, Jay Powell is likely going to disappoint the market. It's quite frankly amazing to us how 3 months ago our call for 2 rate cuts was looked at with extreme skepticism, and now the market is looking for almost 3 by the end of the year and 4 by the middle of next year. That's too far in our opinion. This is not about an economy that's going to go into recession. This is about taking insurance to make sure that the growth path is maintained.
Phil, you say you've got 2 concerns for the markets: a China trade deal, that doesn't happen, and the Fed screws up monetary policy. So what does that mean, screwing up monetary policy? Is it not cutting? Is it cutting too much? What's the risk?
I think Julian's hit the nail on the proverbial head. The core PC number a week or so ago was better than expected. The results out of the G20 meeting, better than expected. The non-farm payroll numbers we saw on Friday, better than expected. If I'm Jay Powell, I'm probably going to try to let the market down easy at Humphrey Hawkins and let them know that it's not a slam dunk that I'm going to cut 50 basis points on July 31st. I may not cut at all. There are some other things that they need to look at over the course of the next few weeks. Maybe we get a small insurance cut, but if the data is strong, the Fed may very well push that out to mid-September, and the market may be disappointed.
Julian, you say that he may disappoint the market. Is 2 days of softness after we got an all-time high kind of accounting for this a little bit? We're seeing yields drift up a little bit. The 2-year note yield this morning is above 1.9. Maybe we're taking a little bit of the certainty, as you say, for very aggressive rate cuts. But would the market, in the moment on Wednesday and Thursday, when they get that message from Powell, truly be disappointed? In other words, is the market radically mispriced at this level for the Fed?
We wouldn't say radically mispriced. I mean, if you look at it, so the market's pulled in from the high about a percent. Very, very, small amount. But that is walking back the probabilities of a cut in July. And we think, again, as Phil said, you could walk back the probabilities more. So to us, what it really comes down to is the market's in a holding pattern. There's an expectation that the Fed is there. The Fed is going to be there. But again, the other issues are still to be resolved. China, Brexit, et cetera. And for us, the next data point will be looking at earnings.
Traders Act, you don't know how you want them resolved. You don't know whether you want it to result in good economic growth or bad economic growth, which is so annoying, given that the previous jobs number was so weak. And suddenly you get this great number on Friday, which should have allayed fears that a recession is imminent or even likely in 2019. And instead, these, I don't want to use a pejorative, but these crack addicts that love free money that trade stocks. I know it, but this is 3 straight days, not 2 straight. If it stays down, it may not today.
Yesterday,
and it's
we
1%.
didn't even get to Friday morning's low.
It wasn't.
Right?
It's not
the reflex reaction was down, and then it rallied throughout.
I would have thought that removing some of the recession fears, at least temporarily, with that jobs number, would have been a positive, and it's not. So how do you know we want a resolution of the China trade deal? If it slows us down, Powell's got to go 50 basis points, and we're back to the races. It's ridiculous.
Well, the real issue for the market here in making further upside progress is that long-term interest rates, in our view, are too low. They are reflecting something, this fear of recession, that we don't think is actually going to materialize. And so what we would like to see, in fact, is the Fed eventually creating some expectation of inflation, sending longer-term yields. I mean, minus 40 basis points in Germany for 10 years, that just doesn't make rational sense to us. Our rates start moving up, you get a more sort of pro-growth mentality and a shift away from defensives into cyclicals like financials and energy. That's what we'd like to see.
Phil, some might criticize these recent all-time highs because we haven't had the participation of transport or small caps to confirm this move. At the same time, you like small caps. You think that there should be a swing higher here.
We do like small caps.
Small
caps have underperformed large caps by 12 percentage points here over the last 9 months or so. We think there's going to be some catch-up. The domestic U.S. economy is doing better than the rest of the world. To Joe's point, our in-house model is suggesting that there's no risk of recession before the first half of 2021 at the earliest. So the naysayers are saying, we started a recession last year, or we're definitely in one this year. We just don't know it yet. We still think that's a couple of years off. So we think that once the market realizes that the economy is in better shape, and we'll get some data to that effect in the second half of the year, small caps ought to participate. But in that environment, given the fact that we're at all-time record highs, and given the fact that we think that the Fed probably ought to do less than the market sort of pricing in, we took some chips off the table last week. We took our equity overweight down from 5% to 3% in anticipation of the fact that, okay, we're at record highs. The Fed could disappoint. The data is not coming in that badly. As a result, we could see some weakness here over the next couple of months. And looking beyond the stuff that Julian and I are talking about right now, as we look ahead to overseas, we've got the Draghi transition, we've got the Japanese VAT tax, we've got the Brexit decision coming up at the end of October. You know, we could have a sloppy, couple of months here.